Good morning, everyone. Hey, I want to thank you for taking 30, 45 minutes of your valuable time to spend a little time with me going over some other options besides fixed rate loans. Today, we're specifically going to talk about some adjustable rate mortgages, a little refresher course, and I'll throw in a little bit about the Buydowns. My name is Gary Martell. I'm one of the owners here at Mountain West Financial. I'm going to spend just a bit of time going through that. So let's get started. Let's talk about the benefits. Why somebody would take other than a fixed rate mortgage. And we've been in such low interest rates for such a long time that it's almost hard in some cases to think about that. But there's definitely opportunities for those that understand and can utilize an adjustable or buy down to better suit their needs. So first of all, it allows borrowers to acquire property they might not otherwise afford or qualify for, and that depends on the loan. We're going to get into both of those in a minute. It allows a borrower who knows that they're going to have an increase in income in the next couple of years to buy a home today that they wouldn't be able to do otherwise, right? That way they don't have to buy a home in 2 years, look to move up if they're not looking to buy multiple real estate, which not everybody wants to do. And it's a great option for somebody that's only going to own a home for a short period, right? Somebody who got transferred in or knows that they're going to be moving in 3, 4, 5, 7, 8, 10 years, and they don't want to keep the home, that they'll pay a lower interest rate during that period of time. It allows homeowners to enjoy an interest rate market when rates are reduced without having to refinance. You know, there's been a lot of negative publicity about some of the loans that were done, especially the adjustable rate mortgages, the 1-year ARMs and the neg-AMs and all that stuff. But the truth be known, if somebody hung on to that loan over the last 10 years, they would have enjoyed extremely low interest rates. And I've heard several stories about somebody who was able to pay off their home because they kept making a payment when the rates dropped after they took that initial rate. And just now, rates are starting to come up. And as most of us know, when we talk to somebody who says, hey, I have an adjustable rate mortgage, I turn it into a fixed, usually the adjustable and the fixed are pretty close to the same rate. And that's designed for several reasons, and I'll go into that. And of course, some of them, depending on the loan, allows for assumptions because the bank's not afraid to let the loan get assumed because they know that it's going to continue to change as time goes on. And for us, for our own personal benefits as MLOs or originators, sometimes, you know, a borrower will come in, we talk to them about a specific rate, you know, I want to get you a 3.5%, and then all of a sudden that market moves away from us. I've seen, unfortunately, originators that have let a whole pipeline die of unlocked loans because they didn't want to make the negative call to the borrower and say, hey, we let the fixed rate get away, and I know that you really wanted 3.5%. Here's an option that we can still get it, whether it's a buy down, but typically that would be done as an adjustable rate mortgage, because I can tell you what I've seen happen many years. Loan officer doesn't want to make that negative call because they let the rate get away. Then the borrower gets a call from somebody else who says, hey, you know, there's still options to get you that fixed rate for 5, 7, or 10 years, and are you interested in doing that? And the borrower jumps on it. So don't let an opportunity like that get away if you have a pipeline as interest rates move. So let's talk about some of the negatives, right? The biggest challenge, at least in my experience, when I talk to a borrower about adjustable rate mortgages, there's been a lot of bad publicity about it and a lot of negative things of why the mortgage market meltdown and whatnot, and a lot of was pointed at some of the adjustables. And there's some of that's true. There was a lot of people that were given loans that they really should have never gotten. They didn't qualify for the initial payment, more or less any payments that they increased, right? And part of that was because we were stacking adjustable rate mortgages with stated income or no income, no asset. But the other thing is, so if a borrower knows that, hey, this is what can actually happen, and with the disclosures today, if somebody sits down and says, hey, adjustable rate mortgage is not for you, or maybe it is for you, and here's the things that can happen with it, sometimes that better suits the borrower's needs. But a lot of people, the big thing is if it's unknown. And the payments can go up even if the borrower income does not. And a lot of borrowers, you know, go, well, I'm going to be making more next year, the year after, and we all hope that that's the case and that's true. but it's not always true, and especially if you end up with a borrower that's now on a fixed rate income, perhaps as a senior citizen that's now getting Social Security or something, they shouldn't go on a mortgage that has, and this is my humble opinion, and again, you know, I'm not your broker, so you want to make sure that you just take what we're saying here, and if you have any questions, you should run how you interact with your borrowers with your broker. But again, some borrowers, if they have fixed rates, they shouldn't be put into a payment stream that can adjust as time goes on. And again, the same thing, if rates go up, the borrower stays in the home longer than anticipated, the payment will go up. And I say that because there are times I've sat down with somebody and they said, hey, we're only going to live here 5 years. Well, that's fine, but when they hit year 6, and if it's an adjustable and rates are higher, then they may not be happy. But you know, until they get to year 7 or 8, they're still probably even with the amount of money that they paid out, because remember, they would have paid less money for the first part of the mortgage. And again, this is predicated off of rates going up, which some point, someday, somehow they will, as we've sat around year after year saying, you know, this might be the year, that might be the year. There is some strong economics going on today, and it appears like it's not just U.S., but globally, the economies seem to be strengthening, which should, at least at a minimum, push rates up a bit. Borrowers may need to budget for increases, and I think that gets along with, you know, we as good mortgage originators would also be coaching our borrower as to, hey, if this increases, remember, you know, maybe what you do is you start by paying a higher payment now, and that additional amount's going to principal. So if it goes up, then what happens is your payment stays the same. You just don't get to put as much to principal, but you are decreasing the balance of the loan. And I'm going to go through an example or two of mortgages, adjustable rates, because one of the things a lot of people don't realize is every time it makes an adjustment, it goes with the then principal balance and the then interest rate. So if somebody's been able to pay down principal, even if it does adjust slightly higher, it's at a lower principal balance, which never happens on a fixed rate loan. And that brings one other thing to light. I've sat down with borrowers and said, hey, I plan to get, you know, I want to buy this house today, and I plan to get $50,000, $75,000 that I want to put down on my mortgage. If you do that on a fixed rate loan, you just lower the principal balance, shorten the term of the mortgage. If you do it on an adjustable rate mortgage, you can actually change your payment as well, which is another opportunity why people would do it. There is additional disclosures, and if you've not done an adjustable rate mortgage since we've rolled out the new loan estimate and CD, I highly recommend if you want to represent your borrower well, which is I'm sure what we all want to do, is you don't do one of these without making sure that you read through the additional parts of the disclosure when it goes out to your borrower or before it goes to your borrower, because there's additional amounts both in the LECD, and there's additional disclosures that go out that explain the adjustable rate mortgage, when it can happen. I would, if I were doing an adjustable today for a borrower, I'd make sure I have those in my hand, do a preemptive call to the borrower and just say, hey, just want to go through this with you, and then if you have additional questions, give me a call. But, you know, again, it brings you up a level above a lot of the competitors that just send out disclosures and hope that the borrower never calls them because they haven't read them themselves and can't answer them. But I'm sure that's not the case with any of you guys. And again, it's always our obligation to educate the borrower on the pros and the cons of any loan. Remember, these loans are really created by the banks many years ago because there was fixed rate loans out there going out of the 60s that were in the 3s and 4%, and all of a sudden the banks, the interest rates just skyrocketed in the 70s, and banks were sitting there paying 10% on savings accounts, and they had 30-year mortgages out there at 3%. So if they could get the borrower to ride the interest rate curve with them, excuse me, that would help the banks, the SNLs, the credit unions, those guys holding the mortgages. Because here we are, you know, the mortgage is designed to keep up with fixed rates over the course of time. So fixed rates go up, your adjustable would go up. Excuse me, if fixed rates go down, then the adjustable goes down. So let's just talk about buydowns first, because they're really the easiest and pretty straightforward. A buy down's normally on a fixed rate product. Years ago, when we were in the crazy years of the early 2000s, we had adjust rate mortgages that actually had a buy down attached to the very beginning. For during that 5 years, you could get a buy down and an adjustable mixed into one product. I haven't seen any of those recently. Not saying they'll never show back up, but you might get a hold of a note or a deed of trust if you're talking to one of your consumers and they bring you in one. There was a couple of those out there back in the early 2000s. Most of the time we talk about a temporary buy down, but we do permanent buy downs every day, right? Excuse me. If the note rate, if the interest rates are 4% at 0 points and the borrower says, hey, I want 3.75, then we have them pay a point and they buy down the interest rate to 3.75. And that's a permanent buy down, right? About a rate down from 4 to 3.75%. And we do that without even thinking about it, but that's what we're doing. There are temporary buy downs out there where you can buy the rate down temporarily for 1 or 2 years, and you do it by prepaying the interest on it. There is a buy down account that's set up, so that money that's out there for the buy down goes into an escrow account set up on the borrower's behalf. And probably the main benefit to a buy down is that it does provide the borrower with the lower monthly payment and the stability of a fixed rate loan, right? It gets rid of the unknown because they know exactly what's going to happen. So let's, who pays for the buy down? That's usually a question. You know, years ago we did a lot of buy downs that were done by the borrower, and there was reasons why that made more sense than it does today. Today, I guess it still could if, you know, if my kids were buying a house and I wanted to help them out, maybe what I would do if they really needed some help at the beginning, I as their parent could set up a buy down account for them. It's prepaid interest, so it doesn't really affect the, your 3% up front. But typically where we see most of these done still today is from contractors, right, developers, new construction. You know, if I can get you into to a house today at 2% where everybody else is going to make it 4%, even if it's temporary, it may be one more hook to get you to look at my track of houses as opposed to somebody else's. In a buyer's market, sometimes we see sellers doing that as well. Most of the geographic areas we serve today, we're still in somewhat of a seller's market or a balanced market. If it does become a buyer's market, I've seen those where a seller will say, hey, I will do a 2-1 buy down, I'll pay this additional amount to help set you up to get you to buy my house as opposed to somebody else. You know, it's just, again, another sales tool that we have to help our real estate community promote their properties. So let's kind of go through an example. So the cost of a 2-1 buy down is calculated by taking the difference in the payment between the interest rates and adding them to determine the savings. For our example, the savings is going to equal the cost, and I'll just kind of run through that real quick. A 30-year fixed mortgage with a note rate of 4% and a loan amount of $300,000. The monthly payments on a 2-1 buy down would look like this. The first 12 months, the principal and interest would be $1168.86. Second 12 months would be $1254.81, and the third year through the rest of the loan would be $1432.25. You want to remember the note rate on this loan is 4%. So if we have a cost of a buy down, what we do is the borrower pays the amount. As we look down, the savings over the months, the first year, they save $263.39 per month from the 4% to the 2%. The second 12 months, they save $177.44 per month, right? And if you multiply that times 12, those two amounts show you what the annual savings is over those 2 years, right? So if you take your what the cost is, if you look at the 4% at $1432.25, and you multiply that times 12, the interest should be $17,187 per year. But in our examples, if you look down, so if you take the $17,187 and you subtract the $31.60, you end up with $14,000, which is the savings for the first year, and the $17,000, which is the savings for the second year. So what we end up with at the bottom is adding those two together to equal the total buy down cost. Because what happens is we set up this escrow account. In this case, we have put $5,289. You see that at the bottom. So for a 2-1 buy down for this $300,000 loan, the borrower pays for the first 12 months $1,168.86. And then what happens is we take out of that buy down account $263.39, add the two together to make the $1,432.25. In either case, the lender is always going to get the $1,432.25 every single month because the note rate's 4%. The amount of the payments is going to be that amount on every single payment. The borrower pays a lesser amount for the first 2 years. The difference comes out of their impound account every year or their escrow account every year, so that at the end of the day, when they get to year 4, there's been no negative. When they get to year 3, there's been no negative amortization, and their payments have gradually gone up. One set of payments for 12 months, another set for 12 months, and then they're at the $1,432.25 for the duration of the loan. Like I say, the good part about this is we know what the rate's going to be from day one. We know what the payments are going to be from day one, so there's no unknown for the borrower. This does help, and again, this is a marketing tool that I see a lot of people get in. We're still going to qualify them at the note rate on this loan because it's a fixed rate at 4%. So let's talk about adjustables. Again, we see a lot more adjustables done today. Buy downs used to be, there was a lot of them done at one time, and now we see mostly ARMs done if we're looking to defer the payment or to minimize the payment for a borrower. So like I said, the buy down's pretty straightforward. It's a fixed rate loan. There's just either a 1-year buy down or a 2-year buy down. So it'd be a 1-year or a 2-1 buy down, and either of those set up an impound or an escrow account for that amount, and we take a piece of that every month, add it to the payment, so the borrower's full payment P&I is made. When we look at an ARM, there's like 5 things that we need to analyze that makes an ARM good or bad, or that it helps serve the needs of our borrowers. There's an index, and I'll go through each one of these: initial contract rate, the interest rate changes, the interest rate or payment caps, and the spread of the margin. So let's start with the index. All adjustable rate mortgages are tied to an acceptable published index. In fact, every note says, hey, if at any time during the mortgage this index is extinguished, then we're going to rely on a secondary index that's going to be just like it or close to it. Usually this is an interest-bearing instrument that moves with the market. I've got a couple of them down here: the LIBOR, T-bills, Wall Street Journal Prime, or I just see Prime in some cases, and 11 District Cost of Funds Coffee. There's several others out there. These are not the only ones. These are the ones that we see most of the time. And typically, these are what we call market-driven rates, or most of them are, right? So every day there's bids and sales made in LIBOR instruments and Treasury bills. The only one that's really not a market-driven rate, it's kind of an artificial, because a bank can just come out and say, hey, we're changing our prime rate today from 3 3/4 to 4%. So that's really artificial because the bank makes the decision to move that rate today. Now, we don't see a lot of loans, a lot of first trustees like your government loans or Fannie Freddie are typically not tied to prime, but you do see a lot of seconds, especially HELOCs, that are tied to prime because that bank wants to make sure that they always have an index above what they consider their best lending rate that they put out to people. None of the indexes move the same. They all should be heading the same direction, about the same amount, but they do change different amounts. I'm going to just, when I looked up last time, LIBOR was a 12-month LIBOR was at 1.83, T-bills were at 1.43, Wall Street Journal Prime was 4 1/4, and 11 District Cost of Funds was 0.732. Now the thing about these is, so you go, oh, well, I want to go to the 11th district. Well, some banks don't offer it, and typically if they do offer it, they're going to have a higher margin based off of it's the most stable and moves the least amount. When I look back about a year ago, most of these were pretty close to the same. LIBOR was at 1.78 and T-bills were at 1.31. There has been a movement in prime. It's gone from 3.5 to 4.25, and 11th District was pretty close. So the initial contract rate, well, this is really what gets a borrower to take this loan. Typically, it's lower than what the fixed rates are today. If we're doing fixed rates at, we'll just say 4% today, you would expect an adjustable rate mortgage to be anywhere from 3.25 to 3.75, but you would expect it to start at a lower rate than what fixed rates are, because otherwise, why would a borrower take any unknowns on a loan if they can get a fixed rate lower than an adjustable, right? So you want to make sure if it's a start rate that it's, whether it's fully indexed or not, if it's a reduced or teaser rate. Now we've had these back for years where even though the start rate would have been 3.5 today in a 4% market, but there was a teaser that went out at 3.25, but it was only out there for a couple months and then it was bumped up. So that was artificially low for 1 or 2 or 3 months just to tease that borrower and get them more into the loans. We see a lot less of this today, as all of us that have been in the business know. Lots of crazy adjustables were out there all the way through about 2006. Matter of fact, it was like somebody's manufacturing a new one almost every week. Today, we're really, for the most part, looking at the same rules and regulations that Fannie, Freddie, and Jenny have as far as how we manufacture, what loan products we offer to the consumers and to our business partners. There is a little bit of non-QM stuff that's starting to surface, but again, it's really still pretty vanillanized. I'm going to see if that word exists. But, okay, so let's talk about interest rate changes. So this is really important, and I'm going to go through some examples in a minute. But when does the interest rate? When can the interest rate change for the first time? So there's been some that had interest rates that changed in month 2 of the mortgage, right? And those don't exist today, but there's a lot of them that change 6 months, 12 months, 2 years, 3 years, 5 years, 7 or 10 years into the mortgage for the very first time. Obviously, a consumer that's going to be in the house 7 years would love to have a mortgage that doesn't change for 7 years. And that may be the one that they look at. Maybe they're okay that it changes in 5 years. Maybe they're going to put a balloon or a large down payment or installment on the note, and they're okay if it changes in 3 years. But anyway, so how often it can change during the life of the loan? Because there's several different caps, and we'll go through those. It's the first cap, and then it's the first change. And after that, what intervals? Because it may wait 5 years before it changes the very first time, and then after that, it may change yearly. Or after that, it may change every 5 years again. So there's a lot of different types of structures still available. The changes are usually annually, semi-annually, or sometimes monthly, 1 year on. Sometimes the changes aren't consistent, and like I say, the loan can change for the first time in 5 or 7 years, and then after that it can change every year from then on. So let's go through a little bit of examples. So here's some different type of change dates. I just kind of looked up some of the ones that have been out there. Not all these loans are available today, but 1 year usually had changed the first time, could change 2%, and then every year after that it could change up to 2%, and then had a 6% life of loan cap. That life of loan cap had to be from the note rate. Again, if we had a teaser rate, so if we had a 3.5% loan and there was a teaser rate at 3.25, the 6% lifetime cap would have been off the 3.5. And a lot of borrowers got lured into loans because if the teaser rate was lower, they're going, well, it can only go 5 or 6% from this rate, but that was only out there to hook you in. The actual rate that the lifetime of loan cap came from was a higher rate. Those don't exist today, but there are still some mortgages out there that have this built into it. A 3-1-year, excuse me. So it stays fixed for 3 years, and then every year after that, and the first change can go up to 2%, and then 2% annually with a 6% life. Then you can see the 5, 7, 10. There's some other crazier ones out there. I'm not seeing these today, but I'm sure they could come back. But like 228, it was fixed for only 2 years, then could change 5%. On the very first change, it could go up 5%, and then would do 2% the rest of the loan, and then have a 5% lifetime cap. So in theory, in month 25, it could go up as much as, it could hit its lifetime cap in the first change. Again, those aren't out there, but There was a lot of those written in the early 2000s, 228s, 327s, again, ones that are 6 months, and then there was a lot of 1 months with a 7.5 payment cap and a 5% life of loan cap, and I'll talk about those a little bit more. Just want to remind you guys, the Mountain West does have an entire array of adjustable rate mortgages that are on our rate sheets today for both our conforming, our high balance, our jumbo, and even our government products. So if you haven't looked at us for those rates, we're very competitive in that arena. So give us a thought if you get there, and you're more than welcome to call one of your very knowledgeable account executives and get some more information on any of those products. And they'd love to come out and give you, or give your realtors or give your office a little chat about these other optional programs to give you more opportunities to close loans. Okay, so let's move on. Interest rate or payment cap. So this is also important because, you know, if I'm going to have a loan for a longer period of time, then I need to know where it's going to cap out at. And again, we're just going to, any loan written today, the life of loan cap is going to be, based off of the start rate today. And if there is a monthly rate, if there's a interest rate cap during any of the change dates, you know, you want to make that as low as possible if the borrower is going to be there a longer time. So what the maximum amount of the interest rate can change to during any given period or at any change date, all loans will either have an interest rate cap or a payment cap. We don't see payment cap loans being made today, so we're just going to say that all loans have to have an interest rate cap at different intervals. And if there's an interest rate cap, there would be, as long as there's an interest rate cap, there's no negative amortization. And that's typically the ones you see most loans today, unless you get into some non-QM stuff, is usually 5.25. We see a lot of those. If you do non-QM, you'll see some of those with a 6% lifetime cap on them. So again, if there's a payment cap, this means a loan has the potential to go negative amortization. So negative amortization, this is only going to happen when there is a payment cap. And we're not doing them today is because they got a lot of people in trouble. And what happened was there were loans written that the payment would be capped every year, but the interest rate could start moving in 1 or 3 or 6 months. So the borrower did always have the ability to keep up with the payments, but a lot of them didn't. And these were neg-ams or MTAs or pick-up payments. There's a whole bunch of things. But what happened was a lot of these borrowers they lost equity in their home because they were not keeping up with the payments. So if they don't, if the amount of any unpaid principal balance would be added to the loan amount, and most of those had a principal balance that if it reached like 120 or 125%, then the loan recast and turned into a fixed rate loan. And when those happened, a lot of those happened in 3, 4, 5 years back in the early days of these. A lot of people ended up with foreclosed houses because their loan balance was 120 or 125% of where they started. And in order for them to catch up, the payments would double or triple. Just put a consumer in some places that didn't exist. On the flip side of that, like I mentioned early on, there were people that with that lower interest rate, those lower payments, when they got their options to pay loans, some of them actually paid the 15-year loan payments while the interest rate was really low, and what it allowed them to do is pay their houses off. So you know, again, all adjustable rate mortgages are all mortgages with an option to have changes and not a fixed rate loan are not bad loans. What they are is they're suited for a specific group of people that are educated and understand that this is a financial instrument to be utilized and not just a house payment. But let's face it, you know, 75, 80% of the people that buy houses, they're buying a home, they're not buying an investment. So we want to make sure that we understand that when we sit down and coach our borrowers. So let's talk about a spread or margin. I kind of look at this as what the bank's going to make as a profit, right? If I'm a mortgage company, a bank, credit union, whatever, and I'm borrowing money to make loans, I can't lend the money out at the same amount that I get the money for because there's nothing in there for me to operate on, right? Every business, you know, has to have income that comes in, expenses, and there's got to be some left over, right? So the spread or margin really becomes more important as the loan starts to age. What happens is, like I said before, you'll see that depending on what the index that they're tied to will have a lot to do with what the margin is. If you see that it's above prime, and again, usually that's for HELOCs and stuff, it's not unusual to see 2 or 3% above prime. If it's on Treasury, it's not unusual to see 2.5 to 3% above the Treasury. If it's LIBOR, it's not unusual to see 2, 2.25, 2.5 above LIBOR. So your margins will be different based off of sometimes what index it's tied to. The bank has looked at this index, how it has functioned over the last 20 years, and that's when they're looking at what kind of profit they're going to make, that's how they're going to put their margins on there. They're probably not looking at it in the eyes of the consumer, how it benefits them. They're looking at it as how they're going to cover their costs and how they're going to stay in business and make money. So when somebody starts at a 3.5% loan, excuse me, for 5 years on an adjustable rate mortgage, and we'll say the start rate's 3.5%, this spread or margin has no bearing on the loan whatsoever for 5 years because it's not adjusted. The spread or margin only become important as the loan adjusts. So until it adjusts, it really doesn't matter what the margin or spread is. It really doesn't matter what the index is, because really I have a 3.5% loan for 5 years. Now, starting year 6, it becomes extremely important that what my margin and what my index are, right? Because now it's going to adjust based off of adding those two together and coming up with a payment. So let's kind of look at that. So let's do one example here. A 5-1 ARM that starts at 3.5%. If I started that, the initial payment would be $1,347. Nope, excuse me, $1,305. Get my numbers right. Then it'll change once a year based off of, in this case, the 12-month LIBOR, which is currently 1.83, a margin of 2.25, change date frequency, and interest rate caps, 2 and 5. And a lot of these have a floor based on them. And a lot of people say, wow, what would a floor do? Well, a floor would say, hey, at no time could it go below 1.83 plus 2%. It could never go below 3.83% after it starts adjusting. Or maybe the floor is 1.5% above LIBOR. So, because if LIBOR were to continue to go down, you know, a bank's not going to want to have a loan that's below like 3.5 or 4% or 3% or whatever that floor is going to be. So there is an interest rate bottom that no matter what LIBOR plus the index add up to, plus the margin add up to, the bank's still going to get a minimum amount of interest no matter what. So, but it is important to know that if this were fully indexed out at 4.08% today, which is LIBOR plus the margin, the rate should be 14.4612. But we're starting off at lower rates, and I really apologize. The payment that I show up on the screen is not correct. It should be $1,347. So the difference between those two is about $100. So the other thing is, if it goes, and we'll just say LIBOR, when it goes to change, moves from 1.83 to 2.64. We'll say LIBOR goes up almost a full percent. Can that happen? Yes. Will it happen? Yes. Will it be in the next 3 months? Probably not. Will it be in the next year? I wouldn't know. I used to think it would be, but now, you know, we've had such low rates for so long that, you know, it's kind of nobody really wants to go out and project rates going up. But at some point they will. So when it does go up, it's always going to look at what the index is. And if LIBOR goes up to 2.64, and it's going to add the margin. That margin never changes throughout the life of the loan. So LIBOR is the only thing that changes, right? The index changes, the margin stays the same. So it's always going to take that 1.83. It's going to add, it's always going to take the index, which is today 1.83, but if it goes up to 2.64, it would add the margin to it, which is 2.25, and now when it goes to change, it could have an interest rate of 4.89%. Now that's just LIBOR going up about 1%. So one of the things, if we were to take this loan and say, hey, It starts at 3.5% today, but it could go up 5%, which would take the loan interest rate to, yep, 8.5%. That's pretty high if you think about it. If I took that $300,000 loan balance and said, hey, let's just do that times 8.5%, we'd have to tell our borrower, hey, your payments, if it were to go up there, would be $2,306. $2,306, that's almost double. That's a lot. But realistically, if the borrower made payments for 5 years, which this one's not going to change for 5 years, so if the borrower made payments for 5 years, they would drive their principal down without any additional principal payments and whatnot to about $285. So if the interest rate was up at 8.5 at the $285, their payment would only be $2,191, $2,191, a substantial increase. So it's interesting, again, to remember that on an adjustable, the margin stays the same. So you want to keep a margin low, and you want to tie it to an index that's pretty stable and slow moving. If anything, you want it as a trailing index, not a leading index. The 11th District Cost of Funds is considered a trailing index. So you don't see a lot of stuff tied to that. You want prime rate can move very rapidly, so you see very loans tied to that because that's really not good for the consumer as well. And remember, as borrowers getting their disclosures, they're going to see typically what they're going to see is what their payment starts at, and it's going to show them the fully indexed rate. So in this case, the fully indexed rate is 14.46. So that doesn't look so bad. It's not really, it's hard for somebody to show 8.5% because by the time we get out there, we don't know what the principal balance would be. But you'd still want to have that conversation with the borrower. Let's talk about one more thing while I'm on this page, because it's really important. A lot of people said, well, we will do this to help qualify the borrower. Years ago on Buydowns, we did a lot of Buydowns to help qualify the borrower because we could qualify them with the bought down rate. Pretty cool. That's not the case today. You would qualify them with the note rate. Most of your adjustable rate mortgages are going to qualify at either the note rate if it's over 5 years, or if it's 5 years or less, in almost all cases, we're going to qualify them either at the fully indexed or the note rate +2, which means that actually it's harder to qualify them at a 5-year mortgage, 5-year adjustable, than it would be a fixed. If you get to a 7, it's not hard to qualify. So you'll see very few people use the 5-year mortgage to try and help qualify. If the borrower is eminently qualified, it's a better loan for the payment, but again, there's some disclosure stuff out there. The other thing to look at is some of the government loans really can help you as far as qualifying as well. If you take the 5-year, then you can qualify, not the start rate. So there's different loans, and I guess my point with this is you want to make sure when you're talking about whether it's Fannie, Freddie, a non-QM mortgage, or a government loan, make sure you understand the qualifying aspect as well, because a lot of times we have a borrower out at the edge of where they're qualified for, and if you talk to them about a 5-year mortgage and then you find out you don't get to qualify them at that rate, that could make a big difference and obviously hurt your reputation and not be good for your borrower to find out. So I guess just to wrap this up, there's a lot of different mortgages out there. There's hundreds of different adjustable rate mortgages. There used to be, I think, thousands of them. It would be enough to almost overwhelm. If you're going to start looking at these for options as rates go up, you definitely don't want to get pigeonholed into just one mortgage. You really want to understand the different mortgages and what they can do for the borrower, so you can give them side-by-side comparisons of several different adjustables and maybe what that looks like to a fixed rate loan. Show them what the difference in interest is over the first 3, 5, 7, 10 years. Even if the adjustable does the worst case scenario, if you have a 1-year arm and you get to year 6 and you compare it to a 30-year mortgage today and the difference is 0.75% of interest, I think all day long you could show them that by year 6 they're still much better ahead with a 5-year arm. By the time you get to year 8, that's not the case. So again, it's that unknown that a lot of times gets people a little leery about mortgages. The start rate, the adjustments, margin, and capture are all varying, can be mixed and matched to find the best loan for your borrower. And I think that's important to understand that, if you look at different people's rate sheets, which, you should just look at Mountain West rate sheets, but in case you wander somewhere else and look at somebody else's, you do see that some of them, they look like a really good start rate, but then, it's got a margin of 3.5% as opposed to 2.25% or 2%. That's not really good for the consumer unless they're out of that mortgage in 3 to 4 years. And sometimes we get lulled into thinking the rates will always stay low. I'm going to bet that that's not going to be the case, but who knows? So sometimes the best solution could be an ARM, could be a buy down, or it could just be a fixed rate loan. So at the end of the day, now you know everything there is to be about adjustable rate mortgages. Actually, that's not the case. There's so much more to know, but I just wanted to give you a little teaser to give you some homework to do. If you look into Fannie Freddie guidelines and HUD guidelines, they really have a good synopsis about adjustable mortgages and the disclosures that go out with disclosures on an adjustable. If you're interested in doing some, contact one of your account execs here. We'll send you one of those disclosures to help you get in front of it. I really appreciate you spending 30 to 45 minutes of your time with me today. I hope you found this helpful, give you something to think about, hopefully give you some conversations to have with your borrowers and your business partners. With that being said, I hope you have a wonderful day, and thanks for joining me.